Welcome back to the Utah Rental Property Insider Podcast, where we help owners, investors, and landlords navigate what's happening in real estate. I am one of your hosts, Parker Nelson.
I'm Nate Kilpack, the other host.
Oh yeah, and today we're going to be talking about what's buzzing around the real estate world and these portable mortgages and how they can affect you. They might or might not impact the Utah County and everything else into it.
So what's a portable mortgage? What's the whole deal?
Well, so portable mortgage is a concept where a homeowner can take their existing mortgage that they have right now and
Interest rate specifically. And with them, they can move them to a new home rather than paying off their old loan and taking out a new current higher rate. Why is something like this even being proposed? I don't know, to be honest. It's kind of a crazy concept because there's certain verbiage written inside contracts of the actual mortgage that you sign, like a due on sale clause, that would have to be rewritten for every mortgage essentially. So normally when you sell a property, the due on sale clause is enacted, and then the new mortgage would take over and then cover it. So whatever interest rate that new mortgage had, this would basically take that out of all mortgages that are currently in existence. So that's kind of a problem.
Yeah.
I guess the government can do whatever they want.
Yeah,
Sorry, that's
exactly,
kind of
right? You would think they can, but in a way they can't.
Yeah.
Hmm.
It's kind of side rail. Sorry.
No.
We can take that out.
No, that's fine.
But why does it matter overall? I think what it'll allow homeowners to do is they'll feel a little bit more free to move if they are wanting to move to a different area or have been wanting to, but they're held back because of current interest rates, makes whatever home or area they're wanting to move into unaffordable. It would allow them to move their current low interest rate into a property that they could now afford, which will allow just more movement in the market, more freedom overall. So.
Mm-hmm.
I think that's a good thing for those that currently have a mortgage and have a home. Yeah.
Mm-hmm. And so would you say this is going to benefit the owners who already have a low interest rate more than a new buyer?
I would say it would only benefit really owners that have, not exclusively, because I think there's some caveats, some things in there that will allow new buyers to get into a home because some of this inventory is going to be freed up because people are moving. Almost exclusively is going to be benefiting people with low interest rates currently. I don't know how it's going to affect, if it's going to be similar to like a 1031 exchange program, where they have to buy something that costs more than their current home, what they paid for it. So yeah, there's lots of unknowns still. But
with this freeing up more inventory, do you think we have an inventory problem, or is it an interest rate problem? Because there's tons of inventory on the market, but nobody really wants to buy because their mortgage is going to be $3,000 plus, rather than they could just rent for $1,800.
Yeah. I think that we ran over a few stats last week, and we'll come out with more. There's more stats coming, but overall we have it's like 25%, something like that, more inventory on the market right now than we did this time last year. Even though that Utah is supposedly in a shortage as far as how many houses we need, I don't know if it's gonna. Fix that problem at all.
I think about that all the time because builders just keep building, but they keep talking about this inventory shortage or, housing shortages. But I'm like, there's tons of houses everywhere, but the problem is just nobody can afford them.
Yeah, it's an affordability issue. And you'd say like the supply demand is like, well, okay, because there's more demand or whatever, that prices will go up. But I think across the board, there's a lot of people that want to buy houses. So the demand is there. They just literally can't afford because of interest rates.
Right. If there was more of like an assumable program to where if you let somebody assume your loan and then maybe they can transfer their existing still short-term mortgage.
Right.
Might help that out a little bit, but.
Yeah, and there are assumable programs, but it's not going to be in your conventional style like what's being proposed right now. Like FHA loans are assumable, VA loans are assumable. So anybody that's even, that is not a member of the military can assume a VA loan. And with FHA, you just can't have another FHA loan when you're trying to assume one. So there are loans that are assumable, and you can get lower interest rates that way. But I think bringing that into the Fannie Freddie like standard conventional loans would actually make a much larger impact than something like this.
Oh yeah, yeah, and just like the 50-year mortgage, I mean, obviously this is going to take time, and there's some hurdles that people have to go through to get this approved. I mean, what are some of the hurdles and challenges that you think will probably occur here?
I'd say the biggest challenges is kind of like what we brought up before, is there are contracts written and signed from hundreds of thousands, if not millions and millions of mortgages that have particular language in their contract with their mortgage company that they'll have to get over that legal hurdle of when you sell the property, the full amount of the funds or whatever is now not due on sale. That now that those funds are going to be moved over to a new property, so it's going to be having to work with private. So in the mortgage market, as you're probably aware, the Fed funds rate and the mortgage interest rate are not the same thing. And it's because the mortgage interest rate is guided by the capital markets. So it's people that are investing in these mortgages, banks specifically that are backing a lot of these, have them on their books as assets, these mortgages, and they sell them to each other for certain margins. And so I think a large part of it is like, how do you get past a lot of that?
Yeah.
The legalities of that.
Yeah, and Realtor.com is talking about, with all the many moving parts, that if people keep their low interest rates and loans and move, loan durations can extend, and investors are at a little bit more of a risk, and it might even push rates up. And so that'll be something to keep your eyes out on.
Yeah, I could see that for sure. And I guess the main losers in all of this are the banks, because they're the ones that are going to be have to holding these low interest rates on their balance sheet. People that haven't gotten into the market, they're not really going to win in this situation.
Right.
But people that are in the market that have low interest rates are really the only winners. So I don't know if it's really going to go, if there's going to be some conflict. Probably if it does get to that point where it's voted on, there's definitely going to be some challenges there. So we'll see. We'll keep an eye on it. We'll keep you informed as this thing rolls along, just like other potential legislative things that will change and impact our local market.
Yeah. Speaking of the local market, I mean, how do you think it will affect the market here in Utah County?
I know that those that would similar, just like those that do have properties, that they would maybe move into neighborhoods that they would want to, have been dreaming about, but haven't been able to upgrade. You're right, and so it'll impact them, which could free up, in some ways, could be beneficial. Free up those starter homes, and maybe those would go for, if there are more on the market, those would maybe come down in price. So that's one impact. I think people that are looking to upgrade, move their mortgage, and then maybe lower their price on their home, so that, because there's going to be more on the market. So I could see that impacting here in this local area.
Now, I'm assuming with the moving of your mortgage, you would have to sell your current house that you're in.
Yeah.
So it wouldn't make sense to be like, sweet, I'm going to move my mortgage, keep my home at that low rate and rent it out, and now I also get this home at a normal rate. Or at a lower rate. And so, I don't know. The more we talk about it, the more this doesn't make any sense to do.
I could see if you're upgrading your home, that makes a ton of sense. Some people that would like to keep their home. We call them accidental landlords. Maybe they want to keep their home or not keep their home necessarily. They can't sell it for whatever reason. They would hang on to their home and rent it out. People that are a little bit more intentional, that are wanting to build a small rental portfolio for their retirement, they would want to keep their low interest rate, so when they bring renters in, it'll cover their costs and maybe make a little bit of money as well, but have that long-term asset as it grows. Their mortgage is being paid for by their residents. So that would wipe that out.
Exactly.
So
but I don't know. I guess we'll just kind of see where things go from it.
So as far as takeaways, what are some of the key takeaways from?
Some key takeaways. I mean, takeaway number one, if you hold a mortgage and it's significantly below market rate, this idea could create more flexibility in coming years.
Yeah. And if you're buying, if you're buying now or managing investment rentals, you can't really rely on this fix for affordability. Overall, like with big market shifts, like structural issues of the actual process is going to be way bigger, and it's likely. I don't see it going through, but you never know.
I could see the 50-year going through before this going through. Yeah, just to keep those month-to-month payments down,
Yeah.
But, another takeaway is just watch policy and regulatory developments. I mean, always, if you're looking to get in the market, educate yourself in the market and what's going on. So always keep an eye out. You don't have to be an investor to do that. You can just look up what's going on. You can follow us. We'll keep you guys updated as well. And
keep you
all
in the
that.
loop. Yeah, with this and the 50-year. I think there are better benefits for the 50-year for people that are just wanting to get in affordability wise. Like I could pay the same rent or put it towards a mortgage.
Mm-hmm.
The likelihood that they're going to keep that mortgage, right, is going to be pretty low. And so they'll try to transition into something else once they've built up a little bit of equity. But it's going to take a lot longer to build up equity with a 50-year mortgage.
Exactly.
That's for sure, so. But anyways.
Yeah, just a couple of things to keep in mind too. Just review your current mortgage rate versus the market. Ask yourself, if I move properties, what are my refinancing implications, right? We talked about refinancing with that 50-year mortgage too. And then engage your property managers, us, about how potential increased mobility could impact rental leasing demands in your area. That's something to keep in mind definitely. And watching inventory and price movement. If mobility increases, you may see more listings compete with your rentals or acquisitions. Yeah, I guess if more inventory does come up, it could even draw prices down a little bit.
Yep. Yeah, I think that's going to be the biggest impact on all this. But yeah, with interest rates specifically, if you need some advice or help with that, we have a partner that can help support that, at least get you an idea on where interest rates are likely going to be trending and, in comparison to what your rate is today. Maybe you bought recently in the past 1 to 2 years, your interest rate's a little higher, when the right time to refinance would be. So usually the rule is if interest rates come down about 0.5%, it's probably worth refinancing. The return on investment for that is typically you want it to be 2 years or less. So your total mortgage will be less than whatever your new mortgage at the lower interest rate would be. Over 2 years. You'd pay yourself back for the cost of refinancing. So.
Yeah. Oh yeah. Well, there you have it.
Yeah.
Yeah. Portable mortgage, they may seem intriguing, but they're aimed to unlock the lock-in effect, and it probably might be one-sided on who it helps. So keep it in mind. And if you're a property owner here in Utah County wondering how your rate, home, or rental strategies might change, if this becomes real, reach out at missionpropertymanagement.com, and we can help you with all of that.
Okay.
Yeah.
Awesome. Till next time.
Till next time.
See ya.
See ya. Cool.